Welcome back to the Deep Dive. Today we're jumping into something pretty fascinating in the trading world. We're looking at a really ambitious idea, trying to bring, well, almost institutional level precision to retail options trading.
That's right. It's quite the goal.
Yeah, specifically we're examining this framework. It's called band distribution style trading, and seeing how it's being applied, or attempted to be applied, to Nadex weekly binary options, which are, notoriously tricky.
Very tricky, volatile, high stakes. Exactly.
Our source material is primarily from Will Duckworth over at Narrowgate Trading. He's the lead strategist there. And he talks about this sort of conceptual breakthrough we had, this fusion. He actually claims it could make trading these weekly options, well, his words were, almost effortless.
Which is a very bold claim indeed. Sets the bar extremely high. And, for you listening, this really frames the whole discussion around that age-old quest in trading. Trying to replace luck, emotion, gut feelings with cold, hard statistical probability. Trying to use math to find that edge.
Right. Can you actually engineer predictability in something like a weekly binary option?
That's the million-dollar question, isn't it? Taking a system meant to map statistical pressure and applying it to something demanding absolute directional certainty by a fixed time.
Okay, so our mission today, let's really unpack the mechanics of this band distribution system. Let's see if the underlying logic, the math, actually supports that effortless claim. So, starting right at the beginning, this core idea, band distribution style trading. What actually is it? What's it measuring?
Okay, so at its core, band distribution is a sophisticated technical analysis approach. It's built around what are called dynamic envelopes. Now, these aren't your simple moving averages. Think more adaptive nonlinear channels.
Adaptive how?
They adapt based on price flow, on volatility. They constantly remap statistical levels of support and resistance, almost like real-time mathematically derived supply and demand zones.
Okay, so they're not fixed lines on a chart. They're moving, adjusting.
Constantly recalibrating, exactly. They create these boundaries, these zones, where the price, statistically speaking, should logically be contained or react.
And Duckworth's system, it uses specific time frames for these envelopes.
Yes, his work specifically highlights the interaction between a shorter 6-hour dynamic envelope and a longer one, usually a 20 or 21-hour channel.
6-hour and 20-hour. Why those two? Why overlap them?
Good question. The idea is synergy. The 6-hour envelope, being shorter term, captures the immediate momentum, the current volatility pressures. It tells you sort of where the market's trying to push right now.
Okay, the immediate picture.
Right. And the longer 20 or 21-hour channel, which often approximates a daily cycle, gives you the bigger picture, the macro stability, the underlying trend structure.
So you're comparing the short-term noise or push against the longer-term flow.
Precisely. By seeing how they interact, you get a much richer signal. If the price breaks the short-term band, maybe it's just noise, a temporary spike. But if it breaks the short band, while it's also pushing against the boundary of the long-term band, that's a much stronger indication. It suggests a potential genuine pivot or a strong continuation.
Interesting. And the source material mentioned something counterintuitive, that the strongest signal isn't always when the price is behaving nicely within the bands.
Exactly. That's a key insight of this approach. Think of it like statistical pressure building up. The further price stretches away from its calculated mean, its sort of fair value within these envelopes, the more pressure builds for it to snap back.
Like a rubber band stretching.
Kind of, yeah. So when the price gets pushed way out to an outer boundary and maybe fails to break through, or if it deviates significantly from where the math says it should be, that deviation itself often becomes the signal. It flags an impending mean reversion, potentially, or sometimes a powerful breakout in the direction of the deviation if it holds. It turns statistical anomalies into trade setups.
Okay, I can see how that framework might work for standard Forex, where you have more flexibility, you can manage the trade over time. But now the big leap, applying this specifically to Nadex weekly binary options, maybe quickly remind us, for anyone less familiar, why are weekly binaries so different, so high stakes?
Sure. Weekly binaries are fundamentally different. They demand absolute directional commitment by a fixed expiration time, usually Friday afternoon. It's truly all or nothing. You pick a strike price, you bet. Will the underlying asset be above or below that price at the exact moment of expiration?
And if you're wrong,
Even by a tiny fraction, a single pip, you lose your entire premium paid for the option. If you're right, you get a fixed, predetermined payout.
so zero room for error on direction by that deadline. The precision needed is immense.
Immense, absolutely. You can't really adjust midweek like with other types of options or trades. You make your bet and you wait. And that's precisely why the idea of using band distribution here is so appealing, because weekly binaries live or die based on having a high probability directional bias.
So the envelopes, by defining these probability windows,
Exactly. They map out where the price is statistically likely to stay or where it's likely to pivot from. They provide, or aim to provide, that high probability directional lean you desperately need.
so if the band suggests strong resistance overhead, the math is basically saying the probability of price staying below strike X by Friday is high.
That's the logic, yes. You're using the statistical map to select the binary strike, the put, or the call that aligns with the highest probability according to the envelope structure,
It moves it away from just a gut feeling, I think it'll go up, towards
an evidence-based decision. Is the price more likely to stay below this level or above that level by expiration, based on the current statistical pressures mapped by the bands? It's applying a form of institutional-level risk perspective to a retail product.
turning the choice into, as the source says, less about luck and more about precision timing.
That's the goal.
Okay, but I have to push back slightly on effortless. Markets aren't purely math labs, right? What about shocks, big news events, central bank surprises, things that blow technical patterns out of the water?
That's always the challenge for any purely technical system. No system is foolproof against unexpected, massive external shocks. It highlights that this is about maximizing probability, not guaranteeing outcomes.
So how does the system account for that? Or try to?
Well, the envelopes themselves are adaptive. They react to sudden volatility spikes by widening, for instance. But more importantly, the source material emphasizes this critical condition for maximizing predictability. Duckworth calls it a rare kind of harmony. This condition is sort of designed to filter out noise and focus on the highest conviction setups.
Okay, the harmony. Let's get into that. What does that mean? What has to align?
This harmony happens when the short-term momentum, which is reflected by that 6-hour envelope, when that moves perfectly in sync with the longer-term trend and stability defined by the 20-hour or daily channels.
So short-term pressure and long-term structure are pointing the same way. No conflict.
Precisely. The entire price structure is unified, statistically speaking. The immediate market mood isn't fighting the underlying trend. When you get that alignment, the claim is the likelihood of price continuing in that unified direction. Just
Yeah. Skyrockets was the term used.
why? Because both timeframes agree. Because the statistical weight of both the short-term math and the long-term math are pushing price in the same direction, there's less statistical reason for it to reverse course suddenly. That harmony is supposed to be the prime moment to enter a weekly binary.
So the system effectively flags. Okay, short-term agrees with long-term. The path of least resistance is clear right now. Probability of sudden reversal is minimized.
That's the essence of it. Maximum conviction derived from the objective data of the interacting bands.
And Duckworth didn't just theorize this, right? He actually tested it immediately.
Correct. He documented an initial live test case specifically to validate the synchronized flow concept for weekly binaries.
Okay, walk us through that test. What was the market? What was the trade?
The test was on a weekly GBP/USD binary option. The system, observing this harmony, signaled a strong downside conviction.
So betting on the price going down.
Yes. Based on that, Duckworth purchased an in-the-money binary put option.
Okay, in the money binary put. Let's break that down quickly for everyone. Put means betting down.
Correct. Betting the price will finish below the chosen strike price by expiration.
And in the money for a binary.
Means that when he actually bought the put option, the current market price of GBP/USD was already below the strike price he selected for the option.
Okay, so you're starting the trade already in a winning position, technically.
Exactly. It's a more conservative entry. You're
Right.
paying a higher premium for that initial advantage, but it aligns with the high conviction signal. You're confirming the system's red before expiration risk fully kicks in.
What was the strike price in this test case?
The strike price chosen for the put was 1.3375.
And where was the actual GBP/USD price when he entered, or around that time?
At the time the source material captured it, the spot rate was around 1.33417.
Okay, so roughly 33 pips below the strike price already. Comfortably in the money.
Correct. Which served as immediate validation for the downside conviction the synchronized bands had generated.
So the test wasn't just a random punt. It was very specific.
Absolutely purpose-driven. The goal was to demonstrate that the band distribution logic, especially when that 6-hour and 20-hour harmony occurred, could reliably predict the directional certainty needed for a weekly binary to be comfortably positioned for success.
Okay, if one framework can consistently find that kind of directional edge, Yeah, the implications are pretty significant, way beyond just one trade. Which leads us nicely into this bigger vision Duckworth lays out, gourmet capital. What is that? It sounds more elaborate than just selling a trading tool.
Oh, much more. With the methodology showing promise, the thinking clearly shifted from does the math work to how do we scale this precision? How do we make it accessible? Gourmet Capital is the proposed vehicle for that. It's envisioned as a network of, interestingly, local franchises.
Franchises. For trading. That's unusual.
It is quite innovative, yeah. It moves away from the typical online course or signal service model.
What's the core aim of this franchise network then?
It boils down to democratizing the institutional edge. Historically, it's really only been the big players, the institutional desks, who had the resources, the quants, the tech, to build and run these kinds of sophisticated mathematical multi-time frame models. Gourmet Capital aims to package that same level of insight, that same systematic precision, and deliver it to the everyday retail trader through a local, supported structure.
So it's not just software. It's the whole process, the support system too.
That seems to be the vision. Source mentions 3 key components. 1, the consistent evidence-based setups coming from the band distribution system itself. 2, localized trader support. Real people, presumably coaching traders locally to ensure they understand and follow the system's rules correctly. Discipline is key.
Right, stops people deviating based on emotion.
Exactly. And 3rd, technology-driven execution. This is crucial. Ensuring that when the system flags a high probability setup based on that band harmony, the retail trader can execute precisely, quickly, without fumbling, removing that human execution error.
It sounds like a direct challenge to the whole guru culture in retail trading, replacing vague advice and hype with a structured, systematic, almost mechanical approach.
I think that's a fair assessment. The stated ambition is bold. Give the average person the tools, the structure, the support to potentially outperform the so-called gurus on Wall Street, not by magic or secrets, but by rigorously applying market mathematics and probability theory in a systematic way.
Wow. Okay, that brings us pretty much full circle on this deep dive. We've gone from unpacking this complex statistical tool, band distribution, with its dynamic envelopes, seeing how it was tested in the demanding world of weekly binaries, looking for that harmony, and landed on this vision for Gourmet Capital, aiming to franchise institutional-grade precision. The common thread is definitely moving trading towards applied math away from guesswork.
It is, and it leaves us, and you, the listener, with a really provocative thought to chew on as this trend potentially develops. If these kinds of sophisticated yet localized and accessible structures at Gourmet Capital do succeed, if they manage to bring institutional-level mathematical precision and risk management down to the average retail trader, what does that actually mean for the future profitability, maybe even the viability, of the more traditional, generalized, non-systematic trading approaches, the ones still based on, basic chart patterns, news headlines, or just gut feel? When potentially thousands of retail traders start deploying mathematically defined edges systematically, does the playing field itself fundamentally change for everyone else? Something to consider.